Right now, a single chip from this company can cost more than its weight in gold. Companies with more money than most countries have tried to build something that competes with it. Almost none of them have. That's strange, because the actual advantage, a faster chip, is exactly the kind of thing a well-funded competitor is supposed to be able to catch up to eventually. 19 years ago, the decision that supposedly caused all of this looked to almost everyone watching like a company wasting money on a feature nobody asked for. This is a story about a bet that took the better part of a decade to look like anything other than a mistake, and about why, once it worked, nobody has been able to unmake it. 3 years after NVIDIA was founded, in a booth at a Denny's, by Jensen Huang, Chris Malachowski, and Curtis Priem, the company was almost out of time. Its first chip had bet on the wrong technical approach, and a follow-on deal with Sega collapsed once Microsoft standardized the industry around a different method entirely. NVIDIA was down to about 30 days of cash. Huang flew to Japan and told Sega's CEO the truth. The product wasn't good enough to ship. Then he asked for the final payment anyway, because without it, there wouldn't be a company left. Sega turned that payment into an investment instead. It bought NVIDIA about 6 months, enough time to build a chip that actually worked, and sell 1 million of them in 4 months. That's not the headline of this story. But it's worth remembering that the person who made the CUDA bet a decade later had already once bet the entire company on telling an investor an uncomfortable truth and survived it. NVIDIA went public in 1999. That same year, it shipped the GeForce 256, widely marketed at the time as the world's first GPU, a chip built to do one job extremely well: render 3D graphics fast enough for games to feel real. For most of the next decade, that's exactly what NVIDIA was to almost everyone watching it: a gaming graphics company, competing with a handful of rivals, in a market that analysts understood perfectly well. Good chips, good quarters, nothing structurally unusual about the business, which is what makes the next decision strange. NVIDIA was about to spend billions of dollars on something almost nobody was asking a graphics card to do. In November of 2006, NVIDIA announced something called CUDA, a way to let its graphics chips run general-purpose computing tasks, not just render images. Here's what that actually cost. Every GPU NVIDIA shipped from that point on, including ordinary gaming cards bought by teenagers who would never use this feature, carried extra circuitry to support it. That's real silicon on every chip, spent on a capability with no proven market. And behind it sat years of software and tooling investment, built for a customer base that, at the time, barely existed. There was no data center boom to justify this, no AI industry waiting for it. NVIDIA built a general-purpose computing platform into a graphics card company's core product, on the theory that someone eventually would need it. Wall Street was not quiet about what it thought of this. For years, CUDA was described as R&D spent chasing a niche group of scientists, a rounding error of a market, funded at the expense of the business that actually made money. In 2008, NVIDIA's stock dropped by roughly 80%. From 2007 to 2015, by most accounts, the company barely grew. Through the middle of that decade, if you'd asked almost anyone to describe NVIDIA in one sentence, they'd have said the same thing they'd have said in 2005. It's a gaming company. Nothing about that assessment was unreasonable. The evidence, for years, genuinely supported it. In 2012, a graduate student named Alex Krajewski at the University of Toronto trained a neural network on 2 NVIDIA gaming GPUs. It was called AlexNet. It entered a competition called ImageNet, a contest to see whose software could most accurately recognize what was in a photograph. AlexNet didn't just win, it beat the next best result by nearly 10 percentage points, a margin large enough that people who studied this field for a living immediately understood something had changed. It hadn't changed because NVIDIA built a faster gaming chip. It changed because 5 years earlier, NVIDIA had built a platform that let a graduate student rent, essentially, a small supercomputer's worth of parallel processing power on hardware that happened to already be sitting in research labs because it was originally built to render video games. Google, Facebook, Baidu, and Microsoft were among the first major companies to start building on GPU-based deep learning after this. Every one of them built it on CUDA, not because NVIDIA was the only option on paper, but because NVIDIA was the only company that had spent 5 uncomfortable, unprofitable years making the software usable before anyone needed it. Look at the same 2 tracks again, years later. On top, raw chip performance. Competitors, AMD, and now custom chips built by Google, Amazon, and Microsoft themselves, have genuinely closed most of that gap. On pure hardware, NVIDIA's lead is no longer the whole story. But look at what's underneath. 2 decades of libraries, developer tooling, and optimized software, compounding every single year since that first uncomfortable bet. A competitor can now build a chip that rivals NVIDIA's on a spec sheet. What they can't quickly build is the reason a team that already has years of work running on CUDA would choose to start over. That's the actual moat. It was never really the chip. Through the 2010s, as machine learning moved from academic curiosity to genuine industry, the pattern repeated everywhere. Researchers who learned CUDA in a lab kept using CUDA at the companies they joined. Companies that optimized their software for CUDA had no reason to rebuild it for a rival chip that might save a little money, but would cost months of engineering time. Each year, the software layer got thicker. Each year, switching away from it got more expensive. Not because NVIDIA made it artificially hard to leave, but because leaving meant abandoning years of accumulated working code. By fiscal year 2026, NVIDIA reported $215.9 billion in total revenue, up 65% from the year before, with its data center business alone accounting for nearly $194 billion of that, about 90% of the entire company. In April of 2026, NVIDIA became the first company to cross a $5 trillion market valuation. By most industry estimates, it holds somewhere between 85 and 90% of the market for AI training chips. None of that happened because NVIDIA finally built a better graphics card. It happened because in 2012, the industry discovered it needed exactly the platform NVIDIA had already spent 5 expensive years building for a market that, at the time, didn't exist yet. The moat is real, but it is not permanent. Google, Amazon, and Microsoft are all now building their own AI chips. Google's TPUs, Amazon's Trainium, Microsoft's Maya, specifically to reduce how dependent they are on NVIDIA. New U.S. export rules in 2026 require licenses for NVIDIA's most advanced chips to be sold to China, a real and direct risk to revenue, one that NVIDIA itself names explicitly as a risk factor in its own financial filings. And not everyone believes the story ends well. Investor Michael Burry publicly argued in late 2025 that NVIDIA was overvalued, a claim NVIDIA pushed back on directly. Every one of those threats is aimed at the same place, the hardware. So far, none of them has found a way around the other track, the one that took 5 unprofitable years to build, and that nobody has figured out how to build faster the second time. It's tempting to tell this as a story about a company that predicted the future. That's not quite it. and it's a less comfortable version of the story than that. NVIDIA didn't know AI would need what it was building. It spent 5 years being wrong, by every visible measure, in front of investors, who said so directly. What it had, that almost nobody else had, was a bet made early enough that by the time the market finally needed it, the hard, boring, expensive part was already finished. The chip was never really the advantage. The years spent building something nobody wanted yet, before anyone could prove it would ever be needed. That was the advantage. And that's a much harder thing for a competitor to buy their way into.